Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. Today we're going to talk about buying a home and the 7 mortgage myths that a lot of people believe are true. There was an article posted on the Money website. It was written by an author named Casey Bond. And what we're going to talk about today is the idea of the American dream no longer including home ownership. There are plenty of mortgage myths that cause people to lose money in the pursuit of becoming homeowners. And I see this on a daily basis when I'm working with clients. This particular author interviewed 7 financial experts to find out what they believe are the biggest mortgage myths and what prospective homeowners need to know. So let's unwind a little bit of these and talk about these. Myth number 1, interest rate and APR are the same thing. And I know a lot of people get confused by this. You'll see an ad on television, the interest rate is, 4.25% with an APR of 5.2%. And a lot of people don't understand what that means, but this is very important. When shopping around for a mortgage, interest rates are one of the most important factors to compare. Well, clearly, getting the lowest rate possible is key. Even a difference of 1% can either save you or cost you tens of thousands of dollars on a 30-year mortgage. It's a big deal. But the thing you need to understand is the APR is the rate that gives you clues about what the fees are included in the loan. So here's what I'm talking about. So let's say you have an interest rate that they're quoting to you as 4%. Real simple example. What the APR includes is any discount points that they may be charging to get the loan. It would include broker fees and closing costs. So that is really a reflection of how you will compare loan 1 and loan 2. So if you're in the market for a mortgage and you're trying out different lenders, and I would definitely encourage you to do that, make sure you take a look at the APR and see what the APR comparisons are. Myth number 2, it's always been better to own a home than rent. Now listen, I'm 45 years old, and when I was a kid, we always taught, home ownership is the most important thing. And, it's always been considered, I've got this investment in my home. But now, home ownership is no longer such a sure bet. Now, there was a fellow by the name of Samuel Dean. He's co-founder of Dean Financial in New York City. And what he states here is that there's no doubt home ownership can offer plenty of advantages. And those advantages include a chance to grow equity and claim tax deductions. But you also need to understand the other side of that. And that is homeownership can also present unique financial challenges that renters don't have to deal with. And for example, we're talking about issues such as maintenance costs, property taxes, and the lack of flexibility. And, if you're a younger person, let's say you're one of these, quote, millennials, and, you're buying a house, you may want to be able to move from city to city to potentially get the best job. So this is one of the areas where owning a home might not be best. And also, with the recent tax law changes, there is going to be a differential now in people who are able to take these things. It probably makes more sense for millennials to improve their credit rating and savings if we're taking a big leap of purchasing a home. Really, there's no shame in renting, and sometimes it makes more sense than buying. So you have to put that myth aside. Myth number 3, buying a home is worth it for the tax deductions. Now, that is true and not true. There's a great perk of home ownership, but it can't be the only reason to buy. I've had a lot of clients say that to me. Well, I've got to get a house and I've got to take out a mortgage, so I have a tax deduction. You also have to remember that tax deductions do not cut your tax bill dollar for dollar. They simply reduce how much of your income is taxed. And truth be told, your actual savings will probably pale in comparison to how much you spend on your home. And don't forget about this. With the recent tax law changes, it's a lot tougher to itemize and take advantage of mortgage write-offs. They interviewed one accountant here, his name is Vance, and he said probably about 90% of my tax clients who itemized this year largely because of the mortgage interest deduction and property taxes will not exceed the standard deduction for 2018. And that's because they've doubled the standard deduction for married filing joint to $24,000. So that is a larger hurdle for a lot of people to get over. But let's keep going on. Myth number 4, you can afford a loan amount you were approved for. And I know this is something that a few years back, before we got into the big housing crisis and the lender crisis, I would have clients to come in and say, I went into the website and I did a pre-approval and it says I can afford a $500,000 home. Well, that may very well be true, but you have to remember, a mortgage lender is not concerned about the cash flow it takes for you to save for retirement, pay for daycare or private school, and save for your kids' child education and vacation. They just want to know that you can pay back the loan. But they're not necessarily concerned about how the mortgage payment will impact your other financial goals. So even though they may approve you, it doesn't necessarily mean it's the right fit for you. Owning a home is an important goal for many people, but it's usually not their only goal. You need to take a minute to really see how a new payment would fit into your budget and include all the ancillary expenses, as well as such things as insurance, taxes, maintenance, higher utility bills, yard upkeep, and HOA dues. So you got to really take a look at this. Just because the mortgage company says, you've been pre-approved to buy a house up to, $400,000 or $500,000. Take a look and see what that mortgage payment is going to be. And then look at the cost of insurance. Look at the cost of property taxes and HOA fees and that sort of thing. Myth number 5. Once you've been pre-approved, you're done. I'm not going to spend a lot of time talking about this, but just this isn't true. You have to be really careful. So even if you're pre-approved for a mortgage, it's important not to make any changes that could affect your employment, income, or credit until those keys are in your hand. And this is a process. Myth number 6, you need a 20% down payment. Now, a lot of people get hung up on this because there's that whole idea of what's called private mortgage insurance. And a lot of people would always say, well, you got to put at least 20% down so you don't have to pay that PMI. The truth is sometimes taking on a bit more debt or temporarily paying private mortgage insurance is the only way to realistically afford a house. If you're in a market where housing properties are, going up quickly, it's going to be very difficult to save 20%. So it may not make sense to do that. So you got to just put that one aside and say, maybe I don't have to put that 20% down. I certainly don't think it makes sense to not put anything down, but you have to look and see, is there a way to earn money on your investments instead of putting the money down, which leads us to myth number 7. Paying off your mortgage is always a good idea. Now, from a financial perspective, I will say, let's talk about that. Now, there also is a psychological perspective to this that a lot of my clients experience. I want to get to the point where I don't have a mortgage anymore, so they go into retirement without that hanging over their head. And living a debt-free life is an admirable goal, but if you have a mortgage, it might not be the most prudent. With mortgage rates being relatively low, a mortgage allows buyers to leverage their money. That's what we're talking about here. And I'll end this with an example. For instance, let's say you have a $300,000 house and a mortgage rate of 5%. Instead of paying $300,000 with cash and having no mortgage, you get a mortgage for $240,000 and pay $60,000 or 20% down. You then take that $240,000 remaining in the market and you could earn 8 to 10% in return. In this case, you'd be leveraging the money you have to earn an additional 3 to 5% each year, rather than sinking all of your cash into the property. This not only allows you to grow your wealth faster, but keeps a good portion of it liquid in case you need it. So if you come across one of those repairs or something happens in your life where you need the money. That's why I'm not a huge proponent of paying off your mortgage. So I hope these 7 myths have helped you and has given you sort of a roadmap of looking to buy a house or getting a mortgage.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.